These are definitely interesting times in the markets, and we've been getting a lot of feedback from our members. And so I put together a bit of a class. I think I've only presented this one other time, and something that I think will help you control the amount of risk you take in these markets, as well as help you increase your probability of profit. Okay, so let me share that with you today. So this is our Mastering Debit Spreads class, and for those of you joining us for the first time and might not be familiar with Trading Wins, we are a group of pro traders with well over 30 years of experience. We're real teachers and traders, and we've been developing our own strategies and trading systems and teaching people from complete beginners to experts around the globe. Now, in today's presentation, I am going to once again go over my money management rules. I do this at every single presentation, regardless of what the topic is. At the core of every trading plan is a solid set of money management rules, and for my students, I make a point of repeating these over and over and over again. I want you to really drill them into your memory and use them. So I will go through those again, and then I will cover the 3 different types of debit spreads that you can use, the pros and cons, and I will also then go through some examples with you on my live charts. And time permitting, of course, I'll try to answer as many of your questions as possible. Please do remember that trading can be risky if you don't know what you're doing, so please educate yourself, and do not trade with real money until you're completely comfortable with the system that you are using. Now, this is how we try to reduce and at some points even eliminate the risk we take in the markets. Rule number 1, I'm sure most of you have heard, and have probably heard it about 1 million times: don't trade with money you can't afford to lose. But really, what this is about is trading with an amount that is small enough that it feels completely insignificant to you. You see, trading is so much more about how you manage a trade once you're in it than it is about selecting that entry point. And when you're in a trade, you really do need to remain calm, think clearly, and manage that trade appropriately. And if you're worried about the amount of money you have in that trade, you won't be able to do that. So please make sure it's always an amount small enough that feels completely insignificant to you. We like to limit each of our trades to 5% of our account balance. Okay, we never put more than 5% in any one trade. And if you are trading with a larger account, please consider reducing this to 2.5%, even 2%. That way you'll have a sizable trade on, but you will be reducing your risk considerably. Now, this rule tends to take people by surprise sometimes. I get challenged on it a lot, but we follow it religiously. We never have more than half of our account active in the market at any one time. Reason being, there's so much when it comes to the markets that's completely out of our control, and any major news event, or I mean, the best example I can give you is a 9/11. An event like that really drives the markets against you, and you're completely helpless, and you really can't do anything about it, and you end up taking a big loss. So first of all, if such another event like that should happen, by only having half your account active, you'll reduce the amount of loss to begin with. But secondly, you'll still have half your account available for you to put back into the markets and make back that loss, okay? And lastly, you want to spread your trades out. What you want to do is identify the highest probability setup and take the 1 or 2 trades, the 1 or 2 highest probability setups for whatever time period you're trading. In other words, recently we've seen extreme levels of volatility in these markets, a lot of back and forth. There have been many examples where the Dow, the S&P, for example, were up huge one day, giving us many signals to the upside, and then the very next day the market pulls back completely. So, you know, on any given day when the market makes a big move up or down, if you take a number of trades in that direction and the very next day it retraces on you, you'll find yourself in a huge hole right off the bat. And that's what this rule is meant to avoid. Okay, so remember, spread your trades out. Be very, very selective. A couple of other rules or sayings that we live by. Number one, you will never go broke taking profits. And I've been challenged on this one as well. Someone usually says you will definitely go broke taking small profits. Well, not if you limit your risk. If you limit it the way we do, you can do very well even taking small profits. But really, the reason for me to have this on the slide is for those of you that are just starting out. You know, as you gain experience in the markets, you will learn to remain in a trade a little longer each time. But at the beginning, when you have those profits, especially in environments like the one we're in now, get used to banking those profits, okay? And always remember that it's never about whether you are right or wrong. That's important, okay? But it is all about how much money you make when you're right versus how much money you lose when you're wrong. So let's talk about debit spreads, okay? There's three types of debit spreads: vertical spreads, diagonal spreads, and calendar spreads, also known as horizontal spreads, okay? Now, in this presentation, I'm going to focus on one of those, even though when it comes to the examples, I'll give you examples of all three, okay? But I really want to focus on the vertical spreads, okay? And a vertical spread is constructed, by using the same underlying security, the same expiration month, but different strike prices. So an example of that would be if we were to go out and open a bull debit spread on Apple, and we were to buy the Apple October 110 call, for example, and sell the Apple October 115 call. So we're long the shorter strike, short the higher strike. But if you look at this, we have the same underlying, the same expiration month, just different strike prices, okay? That's a typical vertical spread. You can also put it on with puts, be the same thing, okay? But in the put example, you would say be long the 115 put and sell the 110 put, okay? But for vertical, same underlying, same expiration month, different strike prices. For diagonal spreads, you're creating these by using the same underlying security, but different strike prices and different expiration dates. So as an example, we'd be buying that November 110 call for Apple, but we'd be selling, say, an Apple October 115 call. So same underlying, different expiration month, different strike price, okay? Why would you put something like on such as this? Well, I'll go into it in greater detail, but basically what you're trying to do is trying to finance part of your long option by selling a near-term option that you're hoping will expire worthless. You'll collect that premium that will reduce your cost basis on your longer option that you intend to hold and for that run-up in Apple, okay? But I'll go through an example for you. And then, of course, there's calendar spreads, also known as horizontal spreads. And these are constructed using, once again, the same underlying, but the same strike prices with different expiration dates. So in other words, same underlying, okay, different month, but same strike. So just like that diagonal, we're selling the near-term month, and we're buying the further out month. But we're doing it at the exact same strike, okay? Again, reason is to collect a bit more premium here. If we're in a situation, for example, where we do expect Apple to move higher, but we don't expect it to do so immediately, okay? Then this is a good way to collect some premium, have your near-term call expire worthless, collect that premium, which will offset most of your cost of your longer-term call, and then hold that call for that run-up in Apple. Okay, it'll make a lot more sense when we get to our live charts. So vertical spreads are perfect for small accounts. I mean, they're great for larger accounts as well. You can really leverage them with larger accounts, but they're great for smaller accounts because you end up spending less. Okay, you're risking less. You're using the market's money to pay for part, if not most, of that trade. Okay, and you're not only reducing the risk you take because your overall cost is lower, but more importantly, you are increasing your probability of profit. Again, when I get to my charts, you'll see exactly why. So it's a great low-risk option strategy for consistent income. This type of strategy in the environment we're in now would really help you, again, reduce risk and increase your probability of profit. So, to recap, the vertical spread consists of buying an option, for example, a call option, at one strike and selling another one at a higher strike to help pay for the cost of the long one, to reduce your break even. Okay, the spread will profit obviously if the strike or if the underlying moves higher. Okay, just like a regular call would. The only difference is your profit will be capped. Okay, by that short call. So depending on where you put your short strike, that will be your maximum gain. Okay, again, I'll go through that in detail. On the flip side, if you're buying a put option, you would be selling another put at a lower strike, once again to help bring in some premium and reduce that overall cost basis. Okay, and in this case, if the stock moves lower, your position will profit just like a put would, up to a certain point. Okay, up to that point where that short put caps the gain. So the main benefit of these is that it allows you to profit from a gain in that stock, okay, without that huge upfront capital outlay. Imagine if you were to buy 100 shares of Apple. You know, Apple's, I'm not even sure what it's at now. What is it, over $100 a share? Huge amount of money you have to put up. And not only that, but you have that full amount at risk, because at any point in time, Apple can gap against you. There could be any kind of news announcement that drives the stock lower, and so that full amount of capital you have out there is at risk. The max loss with these spreads is limited, okay, and it's limited by your net debit. Okay, in other words, with these, the maximum you could ever lose with a vertical spread is the amount that you pay for it. There is no scenario in which you can ever lose more than what you pay for that spread. Okay, so you know your full risk going in, then it's a matter of managing that position and reducing that risk throughout the life of that option, which I will go through. Your maximum gain on the flip side, okay, will happen if the stock price is at or above that higher strike, that short call, okay? So the maximum profit here is the difference between those two strike prices minus that initial cost, the debit. So in other words, if you have a 5-point wide strike, let's say you were buying that 110 and selling the 115, so your $5 wide spread, and you paid $2 for it, your maximum profit would be the difference, which is $3. Okay? Your break even would be calculated by taking the strike of that long call and adding the debit, the amount that you pay for that stock. So here's the formula that you need to have in your head. Very simple to remember. Your break even is your long call strike plus the net debit paid. Doesn't matter whether it's calls or puts, works the same. You take the long strike, okay, plus the net debit that you paid, and that is your break even. Okay. I see there's a few questions starting to come in. Again, I will try to get to you to as many of those as I can. I do have a lot of material I want to get through before my 45 minutes are up, so I'm going to try to get through it a little quicker and then get to some of your speakers, okay? Some of your questions. Time decay. Time decay is very important no matter what option strategy you're using. Whenever you're trading options, time decay is typically something that is an enemy of yours. It's something going against your position. It's that time erosion that hurts you. In other words, if you buy a call, but your underlying starts to trade sideways, okay, takes its time before making that move higher. Every day that goes by that position doesn't do anything, you're actually losing money on your option because of that time decay, okay? But since this strategy involves having a long call as well as a short one, the positive theta decay you receive from the short call could offset most, if not all, and in some instances it will offset all, the negative theta decay of that long call, okay? So this is a time decay graph that I wanted to show you just to help you understand where you should be on here with your long options versus your short options. Whenever you buy a long option, it could be just a straight long call or a long put, you want as much time to expiration as possible. And the reason being is not only will it give you time for that underlying to make its move, but the longer the time to expiration, the slower that time value portion of your option premium will erode, okay? If you look at this line here, if we're at 120 days, you can see it slowly starts to erode, okay, with every day that passes. But once you get within 30 days, even you can call it 40 days here, that's when that time decay starts to deteriorate rapidly, okay? So when you're buying a long call, you want more time in your favor. When you're selling an option, you want the least amount of time possible. That way, that theta decay works in your favor, okay? Trust me, it'll make a lot more sense on the chart. We're one slide away from getting to the charts here. Okay? So is there a risk of assignment with this strategy? Yes, there is. There's always a risk when you have a short option, but generally, okay, it won't occur until the underlying stock price has moved above that strike of the short call, okay? But regardless, you're always covered or protected by that long call option. Okay? The only scenario I want to make sure is clear with you is this. Let's say that you have a position or your short strike expires next Friday, okay? The next expiration. And on that day, the stock right near the close is right around that short strike, okay? It's very close to that exact level. So you won't know exactly whether or not you are going to be exercised or not. And what could potentially happen if you leave it and you don't close out that position is that you do get exercised on the short call and your long call expires worthless, okay? And then you're left with a short position on Monday morning. So whenever you're very, very close and you're not quite sure whether there may be an assignment or not, it's always best to close out that position ahead of time. With most of these trades, the way I'm going to show you, you won't ever be in that position, but I want to make it clear just so no one gets caught by surprise with those, okay? So let me bring up my live charts here and go through an example. Now, obviously, before you put on any kind of option position, you need a reason to buy. Let's look at DVN. This came up on one of our scans this weekend, and I'm not going to go into the reasons why, and I will tell you that earnings are coming up here on November the 3rd, so you got to be careful with this one. We always like to be out ahead of earnings unless we're using one of our earnings strategies, but let's, for argument's sake, say that DVN here, Devon Energy, has bottomed out. We've got a potential double bottom here. It's bottomed out, and we think that DVN is going to go on a nice move higher, okay? It's going to move up to challenge those previous highs. We just, we're not quite sure about the time frame, but we think it's going higher. So how can we use debit spreads to help us out? Well, first of all, when we see something like this, we can do a number of things. We can just buy the stock outright. Again, it'd be expensive, and we'd be taking on a lot of risk. We can also just buy a straight call. Let's go to the option chain here. Let's go to January. If we're just buying a straight call, we want to give ourselves about 3 months or so. January has 83 days to expiration. Let's go out here and let's just go slightly in the money. The 42.5 has about a 65 delta. We always like to go close to 70 or so. Let's choose the 42.5 call here, okay? And let's throw this on our Analyze tab, okay? So there's a couple of things I want to show you with just a straight call here. First of all, it is going to cost you $4.50 or so, okay, for that 42.5 January call, $4.50. Now look at the theta decay. Theta decay, we'll call it 16.5, a negative 16.5. So if DVN, after we purchased this call, just consolidated sideways, didn't really move anywhere, with every day that goes by, we are losing money on this position, okay? Now, how do I reduce my risk? How do I give myself more opportunity to make money? Well, we can put on a straight vertical. So let's go back here to the option chain and put on a straight vertical. So I'm going to go back to that 42.5, right click, and I'm going to go to vertical. Now, this automatically goes to the next strike higher. I'm going to widen it out a little more. Okay, I'm going to go to 47.5. So I want a $5 wide strike. Now, you can see that my cost went from $4.50 to $2.55. So my cost was reduced almost in half by doing that. Why? Because I collected premium from that $47.5 call. I collected almost $2 to put against that $4.50 there. Now, of course, my profit will be capped to the difference between the two strike prices, which is $5, minus my debit paid, which is $2.55. So basically what I'm doing is risking $2.55 to make $2.45, the difference between the 5 wide strike and what I pay. Okay? Now, we can always widen this further. I can go up to 50, 52.5. It depends on the size of the move I'm expecting in the underlying. Okay? But the real key here is this. Let me uncheck this and go back to the single option. If you remember that call, 42.5 cost me $4.50. There's my theta, a negative 16.43. Okay, remember that number. I'm now going to switch, and I'm going to go to my vertical, and you can see, number one, I'm spending less. So I can do one of two things. I can either buy the same number of contracts and reduce my risk because I'm spending less money. Remember, the maximum I can lose is what I'm spending, what I'm paying for this. So rather than pay $4.50, my maximum risk is $2.55. Or I can double up and buy twice the number of contracts, right? But the real key here is look at the theta. The theta on this spread is only 0.44, a negative 0.44. So I've reduced it from a negative 16.43 to a negative 0.44. I've almost eliminated that theta. So now, should this underline go sideways for a period of time, I'm really not losing any money while I'm waiting for it to make its move. Okay, that's a real key for this type of position. Okay, the other thing I can do is put on a diagonal spread. Okay, so let me right-click again here. And actually, before I do that, I want to mention something. Whenever you're putting on a spread which will be at the money, in other words, you can see the 450 is in the money, but the 4750 is out of the money. So we're right around that current price, which is around 45, or it's right in between our spread. Whenever you have that, your risk to reward will be about a 1-to-1, the way it is here. If we put a spread on deep in the money, in other words, let's say we bought the 30 and sold the 35, for example, okay, our risk to reward would go up much higher. It would probably be more like a 4-to-1 or a 4.5 to a half. In other words, we'd be risking $4 to make 1. Okay? But the reason being is our likelihood of success with this goes up exponentially. When we go deep in the money, we're much more likely to end up with a profit here. So our probability of profit goes much, much higher. Okay? But of course, our reward is smaller. Remember, with risk comes reward. And if we're going further out of the money, and let's go, say we go towards the 25 or 20 delta here and look at the 50. If we were to do a 50 to 55, okay, now our risk reward is reversed. In other words, we would only have to risk 1 to make 4. Okay, because it would be very, very inexpensive for us to put this on. We'd be spending a very small amount, and the profit would always be the difference between the strike prices being 5 minus what we pay for it. So you could see if we pay $1.14 for the 50 and we collect 37, we're actually paying less than $1. So our upside would be the 5 minus whatever we paid. We'd capture more than a $4 profit there. The nice part of doing it out of the money, first of all, the negative side is your probability of profit goes down exponentially. So you're less likely to make a profit, but when you do, you're making a much greater profit. The upside here is that if you're only risking 1 to make 5, you really only have to be right 1 time out of 5. Okay? And if you have a system that you're using that allows you to have a much higher accuracy rate, you'll do much better. Okay, but let's look at a diagonal spread example quickly here, and let me right-click and put on a diagonal here. So for a diagonal, now I want to change the months here. I'm going to go back and go to November. Yeah, let's go to November, I believe, and let's use the same strike prices, okay? So I want to go to 42.5 and I want to go to 47.5. I'll show you why. Just make sure I have the right option here. I believe I do. Yeah. Okay. So with a diagonal, now we are long the longer term strike, January. We are short the near month, which is November. We have the same strike ranges. We're long the 42.50. We're short the 47.50. Our cost, you can see, compared to the vertical, has gone up. We're paying a little more for it, okay, 360. But here's the real key. Remember, with our straight call, we had theta of minus 16.43. By putting on a vertical, we reduce that to 0.44, negative 0.44. By putting on a diagonal, it's now a positive 10.11, meaning should DVN trade sideways after we put this on, we're actually going to be making money on this position as every day goes by. Reason being, the short call will expire. That theta decay on the short call is a lot higher than on the long call. Okay. The other thing to think about here is that once the November expires worthless and we've collected all that premium, we can now go back and sell a December call against that January. If that December call expires worthless, we can then go in and sell the January 47.5 against this. Okay, and so we're reducing our cost basis every time and trying to reduce or actually increase our positive theta as we go through the position. That's the real advantage here with these spreads, is the way you can adjust them throughout the life of that spread. Okay, and the other one is a calendar spread that you can put on. Let me quickly throw on a calendar here. The calendar, let me go back to same months for comparison purposes. But these ones would be at the same price. So remember, a calendar, your long strike is your long option is your further out expiration date. Your short is your near term, but they're on the same underlying, same strike price. Again, with this one, the whole reason why you're doing this is you expect DVN to move higher. You just don't expect it to do so immediately. So you're trying to collect more premium by going from the 47.5 strike down to the 42. You're now selling in the money here in November. So you're collecting more premium. Look what happened to your cost basis. Way down. We started at 450 with our single call. We're down to $1 here. And look at our theta. We're now at a positive 12, almost 12.5 on this position. Again, with a calendar, once November expires, we can then switch to and sell in December, and then sell in January, etc. Sometimes even putting this in a credit position. Okay, it all depends on the environment, and it all depends on the movement of that option. The safe thing to remember here is that you can never lose more than what you've spent. Okay, whatever you've paid for it, that is your maximum loss. Let me get back to my presentation quickly here and recap so that I can get to some of your questions here. So, you know, again, what's the reason for you putting on a spread instead of buying a long call or long put? You have the chance of making more money while risking less. You're paying less, you're increasing your probability of profit. Why? Because selling that further out of the money option helps you pay for that more expensive in the money option and lowers your break even. Okay? What's the worst thing that can happen? Well, the whole thing expires worthless, right? If the stock drops below your long strike and the whole spread expires worthless, then you lose the full amount that you paid for it. Of course, you can always use a stop loss, get out partway through. There's different ways to adjust the position, which I'll touch upon in a moment. There's many things you can do. How much margin do I need? Well, this is one of the best things. Absolutely none. Need margin because what you've paid for it is the max you can lose. So what's the downside? Well, slightly higher commissions. Okay? Since you have more than the one contract on, because normally you would buy just a long call, now that you're selling another one, you're paying more commissions. But these days, most brokerages have such low commission rates that it's really insignificant. Okay, so just quickly recapping a few of the benefits. They're not only easy trades to put on, but they require less monitoring, because as the fluctuations happen, the daily fluctuation in the stock happens, remember you've got that short call that whenever the stock goes against you, you're actually making money from. So these spreads allow you to sit in the position a little longer. They're less expensive, so you can buy more contracts if you want and actually leverage your profit. And they offer much more flexibility with regards to adjustments and repairs. And just as I showed you, they can actually be put on with positive theta, okay, which will make money even if the underlying stock remains flat after you open that position. You can also leg into these. You know, you don't have to open that spread as a spread right off the start. You can buy that long call, and then if the stock moves slightly in your favor, sell that call against it and put on the actual spread. That will help you reduce your cost basis even further and increase your maximum profit. Your biggest enemy in trading, no matter what system you're using or whatever option strategy you're using, is the gap. You can never control that gap. But because you're spending less on these spreads, you're obviously risking less by doing it this way. Okay? And they do allow you to stay in that trade longer, giving you a higher probability of profit. Okay? Now, there's a ton of questions. I promise I'll get to a few that I can. I have a few minutes left. Let me tell you about an on-demand recording we have of a pro class we did on these mastering debit spreads just a couple of weeks ago on October 3rd. In that class, I went over the full debit spread strategy, and I showed you a way you can use it in any market environment, but it's really, really key in an environment like we're in right now with extreme volatility. I also went through the calendar of those horizontal spreads and talked about seasonality, seasonal patterns, how you can identify them, how you can use these calendar spreads with those seasonal patterns. The diagonal spreads, which are one of my favorite, that actually turn that time decay in your favor. Ideal, no better time than now. And I also went through some repair strategies, which are key. And these strategies are also strategy you can use regardless of the trading system you use or option strategies. They come in handy. If you're an option trader, you really want to know about these. And also, you know, for that class, we thought, what's the point of giving you or teaching you the option strategy if you don't know which underlying to use those strategies with? So I went through 4 of our strategies that we use that help us select the trades we put on. 3 of those were based around earnings, which we're in right now. So again, very key. And one of them, or one of our core strategies that we've been using for about 14 years here. So the link for this recording is tradingwins.com/debit. And let me tell you exactly what you're going to get so you know that it's right for you. As soon as you order, as soon as your order is processed, it takes about half hour, you'll receive an email with a link to that on-demand recording. It's yours for life. You can access it from anywhere you want and watch it as many times as you want. It was just recorded on October 3rd, so it's brand new material. You will also receive a complimentary invite to any future Mastering Debit Spreads live pro class we have. We plan to have these about once a quarter, and you'll be invited to every new class. And we thought we'd throw in a 30-day membership to our pro service as well. Let me tell you a bit about that, as why it's really one of the most powerful ways to get access to all our systems. We have several that we trade with. You'll also get trade alerts and premium nightly videos that teach you how we use the various systems. In those nightly videos, we highlight trades. Usually there's trades every night. And you'll also have access to our weekly live market chats. You get to come into our room, ask me any trading related question you like. We've had some great sessions. I'm sure you'll love them. And you also get access to all our previous educational materials that are on our website. There's literally thousands of hours of material there that you can watch. So together, all of this is a $691 value, but we really want to just show you what we do here at Trading Wins, and we're offering it to the first 50 people for $47. Okay, tradingwins.com/debit, and this again is everything you get. I think I have a few more minutes. Let me get to some questions here. Let's see. Daniel says unlimited profit for straight trades. Well, yes, technically, you are not capping your upside with the straight trades, like straight call or straight put. But again, you're paying more for it. Your likelihood of success is reduced. And the real key here comes in the adjustments that you make along the way through the life of that spread. That's really the key that makes the difference here. Can you trade weekly options to reduce time decay? You actually can. If you're trading a security, that's Daniel's question. Thanks, Daniel. You can use weekly options, and with those, you can be selling that credit and collecting more credit every single week rather than every month. It just depends on the price level of security that you're trading with. Let's see. Oh, thank you, Joan, for a nice comment. Is a diagonal spread the same as a credit spread from Hector? No, it's not quite the same. A credit spread is slightly different, and there you're doing the the opposite. What you're doing is you're selling a higher strike, and you're buying the lower one for protection, but you're doing it on the opposite side. So in other words, let me bring up my chart just to show you quickly here. If we go to this chart and you thought DVN was going higher, the credit spread you would sell would be a put credit spread, not a call, a put. And the reason being is you want that short call to expire worthless. Okay? You're only buying a lower strike for protection in case the security goes against you. Okay? It's similar in the sense that your profit is capped by the difference between the strike prices minus the amount you collect. Okay? But we've got classes on that as well. Ross is asking me for the. Can I repeat the strike I did for the example? Sure, it was DVN, and these were the strikes. I was using the 42.5 and the 47.5. These were the different examples. The single call costing you $4.50. The straight vertical, where you'd have the same expiration month, both January, 42.5, 47.5. The diagonal, where you'd go long the January, short the nearer term, the November, 42.5, 47.5, and then the calendar, which would be again January, November, but both at 42.5. Okay. What happens to the membership at the end of the 30 days? Well, if you're enjoying it, no need to do anything. It will automatically renew at $97 per month. But if for whatever reason you'd rather not continue, just give us a call before the 30 days are up, and we will put a stop to that. Okay. If any of you have any other questions after I get off the webinar today, or having trouble with your order, email us at info@tradingwins.com. That's info@tradingwins.com, and we will take care of you. The orders are time-stamped, so if you're having trouble with your order, we'll use a timestamp of your email, and as long as you're one of those first 50, you'll be able to take advantage of it. Okay. Please put up the link again. Sure, absolutely. Let me bring that up for you. Right here. It's tradingwins.com/debit. Hopefully we can put that into the chat box, so you can just click from there. Read, if you can do that for us, I'd appreciate it. And yes, it's only $47. This is what you get. You get the on-demand recording from our October 3rd class. It's an on-demand recording you can access from anywhere with an internet connection. It's yours for life. You'll be able to attend any future live classes on this topic as many times as you like for free, and you get that 30-day membership to our pro service, all for $47. Okay? Tomas, yeah, it's tradingwins.com/debit. That's where you want to order from. And I believe I am out of time. So thank you very much, everyone, for taking time on a Saturday to be with us. Really enjoyed it. Hopefully we can do this again. And a big thank you to Reed and everyone else at Investor Inspiration